All right, great to have you with us. And we're starting the hour with a closer look at Canada's economy. About a half hour ago, we got the latest read on GDP. And in the first quarter, you had a relatively strong showing for Canada's economy. All in growth of 2.2%, which was stronger than what Bay Street was looking for overall. And we mentioned earlier, that led to some buying in the Canadian dollar. It starts to signal to people that maybe the Canadian economy is strong enough that the Bank of Canada next week, they've got a key interest rate decision, doesn't have to cut rates. Right now in the market, there's pretty low expectations among the trading crowd that we will see the bank cut rates next week. And yet, do we need to be looking beyond the first quarter? There are some out there that don't shy away from suggesting that we might already be in a recession. And we already know that the federal government is earmarking lots of money as a fiscal support if things go awry for the Canadian economy. So against that backdrop, let's dive into the story and get some perspective from one of our regular guests. Earl Davis is head of fixed income and money markets at BMO Global Asset Management. Nice to see you.
Good morning.
I struggle a little bit with numbers because they're based on what we had seen recently, which is always helpful, but the markets are always trying to figure out where we go from here. Now, the market seemed pleasantly surprised with the performance of Canada's economy in the first quarter. What was your take?
Yeah, it was a good surprise to the upside, obviously, GDP doing better than expected. Having said that, a lot of the reason why it did do better is export driven. So people getting ahead of the tariffs driving the economy. So the question now is, how sustainable is that? Which we know it won't be because tariffs came in. And how much weaker do we get for the second half of the year? One of the things that I find interesting about the number, obviously, it's supportive of equities, new highs, dollar, we've seen the dollar bounce. But what we're getting in Canada is a tale of two streets. One is Bay Street, TSX, dollar, and the other is Main Street. You know, housing is down, employment is down. We do expect slowdown in growth. So how does the Bank of Canada balance that when their only mandate is inflation? And that's where, you know, the market discussion around eases comes about.
Well, I mean, even if you go deeper into the GDP beyond the headline number, like different considerations like investment demand, consumption, there seem to be some underlying themes there that things are softer. And it does feel to me like, you know, the last jobs report was pretty lackluster. And I think there is that concern that if people are losing their jobs and they're worried about home payments, that's not necessarily a great recipe for the economy. I guess on the inflation fight, what would be the reason, you know, when you look at things like core inflation, for the Bank of Canada sitting tight for now? Because it does feel like most of Bay Street, the consensus call is that they don't cut interest rates for now.
Yeah, so the reason why they would sit tight, so inflation number, we got a weaker inflation number last CPI overall, not core. It was like 1.7. But that contains two very volatile items. One is gas, and we've seen what oil's been doing all year, and the other one is food inflation. So the reason why the Bank of Canada looks at core, because there's implications that trends. So if core is high this month, it means that core will most likely be high next month and the following month. That's why that's the number that the Bank of Canada focuses on. Having said that, employment lower, as you said, that means less people have jobs, less people have money in their pocket, less future demand. Housing lower means the wealth effect is lower as well too, less future demand. So it's how does the Bank of Canada balance actual CPI and core, which is their mandate, versus what they see as potential inflation going down a year from now. And that's why the market only thinks it's a 25% chance of an ease at the next meeting next week. But we think it'll be more going forward.
Yeah, and that's more interesting to me because when I look at the calls that are being made on Bay Street, they're quite bold in both directions when you look beyond just next week's meeting. I mean, you've got people like David Rosenberg, granted, generally, he's very cautious on the economy, but he has suggested they should have been cutting more on the rate front yesterday and the day before. I saw some commentary from Scotiabank that seemed to suggest they feel like we could see some rate cuts into 2026, but for now, let's wait to see where things go. And we just had a graphic on the screen suggesting that you wouldn't be surprised to see some rate cuts later this year to the tune of what, like 325 basis point cuts?
Exactly. So right now the overnight rate's 2.75. We would expect it to be 2% by the end of the year. Why is that? We expect growth concerns to pick up during June and July based off the tariffs. It takes a little while for those numbers to flow through. And what that does, although we are experiencing slower growth, it also impacts the psyche of the buyer. So someone saying, oh, look at growth, it's going lower. I have a job now, but maybe I won't spend. Maybe I'll save that extra dollar just in case. And the Bank of Canada wants balance there. They don't want everyone saving all the time. They don't want everyone spending. And I think they get that balance now if they ease by about 75 basis points by the end of the year.
So if that were to happen, like there's probably sectors, including banking, construction, probably even retail, that would benefit from lower interest rates. What's the balancing act going to look like here? I mean, should we be having a conversation around a recessionary environment? Because, how does the Bank of Canada know when to sort of lean in one direction over another at the end of the day? If the street is right and we don't see a move on rates next week.
You know what? In the end, it's an art.
Yeah.
Nothing's certain. And it's interesting how you said before, Rosenberg on one side saying, you know what, they should have eased more. Scotia on the other side saying, let's hold off. You know what that tells me? They're doing a very good job because they're in between. The economy isn't in a good place. I don't anticipate a recession personally this year, nor next year at this point in time. And that's because the U.S. is still doing well. We're still an export economy. There's been global eases around the world. Europe's easing, UK is easing. That benefits Canada from an export perspective. So there's a lot of things happening outside of Canada that says, you know what, I don't think we'll get a recession. Yeah. We'll get lower growth. And that's what the Bank of Canada is looking at and trying to analyze.
Real quickly before I let you go, in the stock market, because you had such a big May, a lot of people are wondering if that was some catch-up trade tied to, confusion over tariff policy and all that kind of stuff, and if, things are going to get sour. I know you're the bond market guy, but are you anticipating any massive volatility in the markets this year, or is that maybe not that we haven't had volatility, but are you looking for sort of an orderly, stable market for the rest of this year, or stay tuned?
Yeah, it's a very good question. Yeah. We do expect volatility, but a very broad range of volatility. And in the bond world, it'll probably be driven by growth, inflation, and bond supply going forward. So what does that mean? To me, that's why it's perfect to be an active fixed income manager, because at times we'll be overweight duration. At times will be underweight duration.
Right.
Same thing with credit and risk assets, which is reflective of, equities and whatnot. Right now, we like risk assets. It's just how much do we like it? Are we very overweight or slightly overweight? And that's the great thing about being an active manager in this world. Our view reflects, it's pretty steady growth, but it'll be some volatility around that.
Okay, well, we'll let you get back to that active life you live in the bond market for the opening today. Earl, thanks very much. Earl Davis joining us. Now, one of the